Hey everyone, welcome back to Corporate Decoder, the place where we break down those confusing corporate documents and find the juicy bits. Today we're diving into an amended filing from Hartford Creative Group, Inc., the company that changed its name not once but twice. Let's see what adjustments they had to make and what it really means for their business. Their latest filing is an amendment to a previous report, and it looks like they had to go back and fix some things related to who they consider a related party. This is pretty important because it affects how they report transactions with certain companies or individuals. So, what happened? Well, the company is filing this amendment primarily to fix disclosures about related party transactions. They missed identifying some relationships that apparently got reinstated towards the end of last year. One big change is that as of the 26th of November 2024, a person named Miss Erin Songwang acquired a significant chunk, 39%, of the company. This move then made two other companies, Shanghai Chaohong Assets Limited and its subsidiary Shanghai Overseas Chinese Culture Media Limited, considered related parties. Basically, when a major owner buys in, their other business dealings can become connected to the company's financials. Then, just a few days later, on the 2nd of December, another company, Shanghai Kongluzai Brands Management Limited, also became a related party because it was bought by Shanghai Chaohong. This means all the financial dealings between Hartford Creative Group and these entities now need to be properly disclosed, which they apparently failed to do initially. Now let's look at the numbers. We're recomparing the 31st of January 2025 to the 31st of July 2024. Their cash position has dropped quite a bit from over $310,000 down to just about $35,000. That is a noticeable decrease, suggesting they might be spending more or bringing in less cash recently. Accounts receivable also took a tumble from $573,000 to $135,000. This could mean they collected more cash from customers, or perhaps they reselling less on credit. On the flip side, their related party loan receivable jumped from around $138,000 to nearly $668,000. This indicates they loaned out a significant amount of money to parties, now identified as related, which is a pretty big shift. Overall, their total current assets fell from about $3.5 million to $1.7 million. That is a significant contraction, showing a much smaller pool of short-term resources. Accounts payable also saw a huge drop from over $1.3 million down to just under $120,000. This could mean they paid off a lot of their short-term debts or perhaps delayed payments, but the numbers suggest significant payments were made. Their related party loans and payables, however, increased slightly from about $3.93 million to $3.98 million. This suggests ongoing financial ties and potentially more funding coming from these related parties. As a result of these movements, their total current liabilities decreased from over $7 million to about $5 million. So, while current assets are down, their short-term obligations have also seen a reduction. Looking at the big picture, their stockholders' deficit improved. It moved from a deficit of about $3.35 million at the end of July 2024 to a deficit of around $3 million by January 2025. This is good news, as it means the amount owed to shareholders, in theory, is getting smaller. Now let's talk about how they're doing financially. For the 3 months ended the 31st of January 2025, revenue was $378,037. This is a massive jump from zero revenue in the same period last year. This huge increase is driven by their new advertising placement services launched in 2024. Interestingly, they had $62,443 in related party revenue in the prior year, which is now zero. This shift shows they are growing their business with non-related parties. Operating costs and expenses went up significantly from $77,447 to $201,187. That is a 160% increase. The company attributes this to investments in scaling up operations, hiring more people, and increased marketing. This led to a positive operating income of $176,850 compared to a loss of over $15,000 in the previous year. This is a dramatic turnaround, showing they are becoming profitable from their core operations. They also booked a gain of $21,362 from selling off some of their subsidiaries. This helps boost their bottom line. And their income tax expense jumped to $75,620, which is a direct consequence of becoming profitable. Ultimately, they reported a net income of $144,015 for the 3 months, a huge improvement from a net loss of nearly $20,000 in the prior year. year. This is a very positive sign for the business. Let's look at cash flow. This is where the money is actually moving in and out of the business. For the 6 months ended the 31st of January 2025, they reported a net income of $271,284. Here is where things get interesting. While they had good net income, there was a massive increase in the advance to contractor line item, a jump of over $1.5 million. This means they paid out a lot of money upfront to contractors. They also had a significant decrease in accounts payable, a reduction of over $1.2 million. This indicates they paid off a considerable amount of their supplier debts. All these movements resulted in a positive cash flow from operations of $183,914 for the 6 months. This is much better than the cash used in operations of over $34,000 in the prior year. In their investing activities, they had a cash outflow of over $529,000, largely due to making new loans to related parties. Financing activities brought in about $19,000. This was from taking out new loans from related parties, partially offset by repayments. Overall, their net change in cash was a decrease of $275,200. This, combined with their starting cash balance, led to their cash ending position of just $35,563. This low cash balance, coupled with recent operational changes, does raise some concerns about short-term liquidity, even with the positive net income. The company's history is quite a journey. They started in photography, moved into education and hospitality in China, and then pivoted to media and marketing in early 2024. Their education business was hit hard by government regulations and pandemic restrictions. They sold off parts of their education business to related parties back in 2022. Now, they are fully focused on media and marketing, especially on social media advertising platforms like TikTok and WeChat. They aim to offer a complete suite of services, from creating ad content to managing campaigns. Now, for a critical point, the going concern note. This is where the auditors flag if there is substantial doubt about the company's ability to continue operating. As of the 31st of January 2025, Hartford Creative Group had a working capital deficit of over $3.2 million and an accumulated deficit of nearly $5.6 million. These numbers mean their short-term liabilities are much higher than their short-term assets, and they have a history of losses. This definitely raises substantial doubt about their ability to keep running as a business. The company states its survival depends on getting more funding and becoming profitable, but they cannot guarantee that will happen. This section details that they loaned out a significant amount, over $800,000, to Shanghai Konglu Zai Brands Management Limited, which is now a related party. A portion of this loan was repaid, but a large balance remains. Here is where it gets intricate. They owe money to Shanghai Chaohong and Shanghai Overseas Chinese Culture Media Ltd, which they describe as funding support for operations, bearing no interest and due on demand. They had a break in this relationship, but it was reinstated due to the new ownership structure. They also have outstanding loans and advances from related parties, including a former primary shareholder, totaling hundreds of thousands of dollars. They are also leasing office space from a relative of a major shareholder, and their principal executive office in California is leased from a former primary shareholder. These are all connected transactions that need careful monitoring. This relates to their advertising placement business. They are paying significant amounts upfront to contractors, over $870,000 currently, and also receiving advance payments from customers, holding over $551,000 in contract liabilities. This is a major red flag. For the 3 months ended the 31st of January 2025. One customer accounted for a whopping 85% of their total gross billing. 2 customers accounted for 72%, and they had a large outstanding receivable from one customer. This level of reliance on a single or a few customers is very risky. If that customer leaves or reduces their business, the impact on Hartford Creative Group could be devastating. They also have a concentration risk with their suppliers, with one contractor accounting for 82% of their services acquisition. This means they are also very dependent on a few key contractors. Something important happened after the reporting period. On the 24th of February 2025, they filed a registration statement to sell up to $10 million worth of their common stock. This is a common move for companies that need to raise capital, but it also signals that they are burning through cash and need a significant influx of funds. The company is very upfront about needing to continue as a going concern. They acknowledge the substantial doubt due to their deficits and state that their future hinges on obtaining debt or equity funding and achieving profitability. Their plan is aggressive. They've shifted entirely to social media advertising and are aiming for international expansion by helping Chinese customers market in the US. They are also developing a mini drama business, which sounds intriguing and potentially risky. Looking at revenue, we see that massive 505% increase from $62,000 to $378,000. That is undeniably positive growth. And their operating income swung from a loss of $15,000 to a profit of over $176,000. This is a huge operational improvement. Net income went from a loss of $19,000 to a profit of $144,000. The business is clearly making money operationally in this period. For the 6-month period, revenues surged by an astounding 1,254%, from $62,443 to $845,499. Again, this shows strong traction in their new business. Operating income turned positive, reaching $368,922 from a loss of $35,196. And net income for the 6 months is $271,284, a massive turnaround from a loss of $45,453 in the prior year. From a pure profit and loss perspective for this period, the company looks like it is on a strong upward trajectory. However, the liquidity section paints a starkly different picture. Despite the profits, their working capital deficit is huge, and they are actively seeking significant financing. They need over $2 million for the next 12 months, and are looking at debt or equity to fund this, which will dilute existing shareholders. This constant need for external funding, despite reporting profits in this period, is a key concern. Finally, their internal controls are flagged as not effective. They mention a lack of proper authorization and approval procedures, as well as issues with accounting personnel and segregation of duties. This, combined with the going concern warning, suggests that while they might be making some operational progress, the underlying structure and financial management could be shaky. So, what is the story here? Hartford Creative Group is in a dramatic turnaround phase. They've successfully pivoted to a new growing market in social media advertising, and their current operating results show positive income and revenue growth. That is the good news, and the company is clearly riding that wave. However, there are significant headwinds. The company has a long history of losses and a very large accumulated deficit, and they are in a precarious cash position. Their heavy reliance on a few customers and contractors creates enormous risk. On top of that, their internal controls are not effective, and they are very open about their need for substantial external funding to survive. While the growth in their new business is impressive, it is happening in a context of significant financial fragility. The company's direction seems clear, but their ability to execute that plan and manage their finances prudently will be crucial. Keep an eye on their ability to secure the much-needed funding and whether they can diversify their customer base to mitigate that significant concentration risk. It is a bold bet on a new industry, but the financial foundation still appears quite unsteady. Alright, that is our decoder on Hartford Creative Group's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.